Okay, well, thank you very, very much for those of you who've already dialed in, and a welcome to taking time out of a busy schedule. My name's Richard Lowe. I'm the CEO and founder of Turn-Keyinvestments. I'm dressed in a rather different shirt tonight. I'm actually in Lombok in Indonesia. So I thought with the flavor of being in Indonesia, I'll wear a batik shirt. I'm here because one of the properties that we have been marketing on behalf of the Sailor Group, called Selong Selo, a stunning 5-star villa resort overlooking one of the best beaches in Indonesia, and I hadn't visited it, so I'm out here in Indonesia having a real hardship time. So anyway, without further ado, tonight's topic, as you can see from the title, is a comparative guide to 3 lucrative UK real estate investment strategies. And it's a webinar that I've never done before, and I thought it would be an opportunity to really do an opportunity to compare and contrast different real estate related investment strategies and products. So hopefully through the seminar, you can have a better understanding of different investment strategies with a view to diversifying. We'll be covering 3 key topics, which will be your traditional buy-to-let investment, where you buy the property, you're the owner of the property, collecting a rent, and at some stage looking to sell that property with a capital gain. We're going to be looking at UK government guaranteed social housing and supported living, which certainly in my opinion is one of the lowest risk but high yielding property investment asset classes, together with a short-term investment, which is a UK property bond working with a very established developer that's been in business for over 30 years. So hopefully at the end of it, what we'll then do is really compare the pros and cons of the different investment strategies so that you can decide, what fits best for your risk appetite, what your investment goals are, what your time horizon may be. Before getting into that part, I thought I would just do a little bit of an update on the UK property market, more towards the impact of interest rates and what's happened in the UK real estate market since interest rates have gone up. Just a few macros though to start off with. This is a graph showing the number of properties delivered on average each year. And we can see that it's, from 2000, the year 2000 on the far left, we're looking at about 130,000 units. Around about 2019, it peaked out at just under 250,000 units delivered. But the government has estimated that the UK needs an average of 300,000 units built every single year in order to keep up with demand. But we can see over decades that at no one year has the construction industry and real estate industry been able to deliver 300,000. And so the situation is actually getting worse rather than better. And certainly one of the fundamental drivers in any industry is the supply-demand deficit. Now, I think most of the people on the call tonight are from Singapore, but we do have others I know from Malaysia and 1 or 2 other countries. The influence of currency when you're investing in an asset class outside of your base currency, in this case, Singapore, which is where I live, and most of you that are on the call tonight, we can see that if we look back towards June 2015, the exchange rate was about 2.2 Singapore dollars to the pound. Today, it's hovering at around about, excuse me, about 1.67 Singapore dollars to the pound. So over a 20% swing. And that was really triggered as we got into the Brexit referendum and the concerns about what was going to happen to the UK. And really that exchange rate, within about a year or so of the announcement of Brexit vote and the exit from the European Union, the pound sterling has definitely fallen. If I was to be able to extrapolate further than 10 years, I remember selling a property back in 2007 when the exchange rate was actually 3.15 Singapore dollars to the pound. And so compared with 2007, the buying power of the Sing dollar now is about 50% stronger than back in 2007. So for those of us who live and work and earn in Singapore dollars, we really are in a very lucky position with a strong currency, particularly when we compare it to the pound sterling. Now, let's focus a little bit more on the interest rates. If I go back to what happened in COVID times, initially when COVID hit, many people anticipated that the world will go into a major recession. Real estate would probably follow suit and we'd start seeing major house price drops. But in actual fact, the opposite occurred. People realized that where they lived became more important, maybe working from home, certain benefits from the government where we had stamp duty holidays, and at that time, historically low interest rates. And so what we were seeing is a bit of a buying frenzy, especially a race for space, and property prices were rising at double-digit capital growth year on year for a few years. But what we've seen really in the last 12 to 18 months, maybe triggered by the Ukraine war, and the fact that affordability and the cost of living and rising prices due to inflation, what we've seen is rising interest rates, as most central banks use increasing interest rates as one of the main methods to try and curb and bring down inflation. So what's happened is interest rates have gone in the UK from 0.1%, which is the lowest in over 300 years, to now over 5% as the base rate. And really what's happened from that is that many people now can't afford a mortgage, so they're forced to rent. And what we've seen in the rental market is a rapid increase in the number of people looking to rent places. That's triggered a major undersupply in rental property, and rentals in the UK, as well as many other countries, Singapore as well, has seen major growth in rentals. So it's a real challenge for many people now to be able to afford a property. And so what we've seen is many people who would aspire to buying a property are just not able to do so. So they're forced to rent. So there are less buyers in the market. And so we've seen a real softening in the property market. Interestingly enough, though, there's been, over the last 2 or 3 years, I've seen internet headlines saying anywhere from 5% to 30% drop in the estimated property market. The reality is that the market has softened. Prices are fairly flat at the moment, but we've certainly not seen major drops in overall prices. Now here, this is a graph that shows the Bank of England base rates over the last 50 years. And we can see in the last sort of 10 to 12 years that, it's below 1%. And so my guess is that if you are 40 years or younger, you probably never really experienced high interest rates or higher interest rates. You've only known extremely low interest rates. If I take another extreme, if we go back in this graph to 1981, the base rate was at 17%. I remember when I bought my first property in the UK in 1997, I was paying about 7% interest rates. And so if we were to take an average of the base rate over the last 50 years, with interest rates now for foreign buyers between sort of 6 to say 7.5%, overall over the scheme of things over the last 50 years, actually the interest rates are still relatively low. It's just relative to what they have been for the last decade or so. So what we have started to see, though, in the last couple of months is that as the lenders feel that the Central Bank of England have probably reached pretty much their their peak of increasing the base rate, and there's a little bit more stability, and they kind of see where the market's going, we are starting to see more lenders coming to the market, more lenders wanting to get more market share, and so more competition has created benefits for borrowers, whereby this rate was just released a little while ago at 4.99% fixed rate. Now, I should add that is for somebody who resides in the UK and not necessarily a foreign investor. Now, this graph or bar chart really blew me away when I first saw it. What it's taking is about 11 different snapshots in different times of history going back to 1972. And it's taking a snapshot of what happened to property after an interest rate hike. So the black bar is showing what happened to property prices a year after the rate hike. The silver is 2 years after the rate hike, and the brown is 5 years after the rate hike. Many people just make the assumption that when interest rates go up, property prices will come down. And yet what we can see in 10 or 11 snapshots here is quite the opposite. In actual fact, prices of property have still increased even after a rate hike. And I think it still comes down to that fundamental of the supply demand. Even though the increase in interest rates can be painful short term, people still need a place to live, and there is a huge undersupply in the UK property market, and we have seen increases. I think potentially what could happen is that in the last 12 to 18 months, where we've seen a slowdown in the number of buyers in the market because of the high interest rates, that if we have turned a corner and we are going to see interest rates coming down in line with inflation over the next 12 to 24 months, there's an awful lot of people that are paying high rents and are almost certainly going to want to get onto the property ladder. And with a surge in buyers coming back into the market, almost certainly there will be a corresponding increase in property prices. So one could argue to say that now is pretty good time to invest in a property. It might be that thinking about buying an off-plan property that completes in 1 or 2 years' time, with the assumption that interest rates come down, but you're able to buy at property prices now before they start to increase. Okay, so let's get into the main part of the seminar tonight. But before I do so, I want to ask you a question, and I want you to think about what kind of annualized returns would you like to see in an investment? Here, I'm focusing on UK real estate related investments. Most people would say that the UK, being a mature, stable market with a good rule of law, is a lower risk place to invest in real estate compared with maybe an emerging market. So putting that into context, what I'd like you to do is have a think about what kind of annualized return would you like from a UK real estate investment? Is it 3% per year? Is it 5%, 10%, 50%? There's no right or wrong answer, but I'd be curious to know, and if anyone would like to just sort of even put into the chat box what they think would be a reasonably good annualized return based on a low risk, stable real estate market. So I'll leave it to you if you'd like to put something in a chat box just to kind of get a sense of what your expectations are. But I'm going to come back to that when we come to virtually the last slide, where I'm going to do a comparison between the 3 different investment opportunities and the pros and cons and the potential returns for each of these different investments. So what do I mean by a UK traditional property investment? It really is what most people are exposed to in this part of the world, where a developer wants to market a property to an Asian investor, and you decide that you'd like to buy that property, become the owner of that property, enjoy a rental income from that property, and over the long term, hopefully get a capital growth as well. So that's really what I mean by a traditional property investment. Well, let's have a look at some clips from news articles in recent weeks. The far left shows UK housing market forecast to avoid slump despite zero growth in prices. So zero growth is not as bad as some of the headline grabbers I've seen, which was saying up to 30% drop in the house price market. So zero, it's not great, it's not going up, but it isn't that you're losing the shirt off your back. One of the other issues that's really facing the government is immigration, and it was released about a couple of months ago that over 600,000 immigrants had come into the UK in the last year or so, which was the highest, I think, since records began. Now, those immigrants are very often put up in either temporary accommodation or social housing, which we'll be touching on in a moment. And so with an influx of more immigrants, there is an even higher need for social housing. I mentioned that rents have been going up. I have a property in Manchester and it's gone up significantly in the last year or so. But it's been stated that rents have almost gone up by 20% across Manchester. And as touched on before on the far right, the average UK mortgage rates fall for the first time in 2 months. So, I mean, based on this, again, looking into the crystal ball, it does appear that we may be turning a corner with interest rates. And as those interest rates come down, we'll almost certainly see a return to more buyers coming into the market and probably an increase in property prices. Now, this graph shows the average price of a property in the UK going back to 2005, where it is at 150,000. It moves upwards until we get to about 2008, 2009, which was when the global financial crisis hit. And the average price of a property dropped by about 18%. And that's the biggest drop since records began in the 1960s. But soon afterwards, we can see that the property market starts to recover. And interestingly, as we go to the far right, instead of the property market going into a crash during COVID, we can see that the line gets steeper, and actually prices were accelerating in COVID for the reasons that I've mentioned previously, albeit we have now seen the market flatten off. Now, here, this is from the Office of National Statistics, showing the UK and London house price index over the last year. Again, interestingly, the snapshot that was taken for this one particular year shows that the price of property has actually increased by 3.5% across the nation. For London, it's appreciated by 2.4%. So again, slight growth in the snapshot that we've looked at in the last year. But again, it's not a property crash, which is what a lot of people were concerned about. HomeLet here is a platform that tracks rental market across the UK. And here we can see both the national rental averaging actually at £1,213. And we can see that the average rental had gone up by 10% across the UK. And in the same time frame, London, the average rental just over £2,000, and it increased over the last year by 9.3%. So again, just reinforcing what I'd said, more people can't afford a mortgage, so they're forced to rent, and so more tenants out there vying for the same number of units, and market forces, supply demands has meant that landlords are doing very well. Unfortunately, people looking to get on the housing ladder are struggling. And here we have an example of a property that we recently launched. And again, it's a classic example of a traditional buy-to-let in Manchester, which has been one of the best performing cities in the UK over the last 5 to 10 years. So again, that traditional property investment, you're buying a property, in this case, the entry level, £189,000. It is an off-plan property that's due to complete in early 2025. There's only 10% that you need to put down on an exchange. and then the balance is on completion. So for one of the less expensive units, you're only looking about £19,000. Estimated yields between 6 to 7%. So even with high interest rates on an interest-only mortgage, you'll almost certainly be cash flow positive. And of course, over time, one's looking for a capital growth. So a traditional buy-to-let in Manchester, in this case, Trafford Gardens, which is a stone's throw away from the Old Trafford football stadium. In fact, it's even closer to the Trafford cricket ground for those people who are familiar with the geography of Manchester. So for many people, this is primarily what they invest in when they think about real estate. And it is, a stable asset class where over the medium to long term, you're looking at capital growth and enjoying a rental income along the way. So now let's have a look at UK government guaranteed social housing and supported living. So what exactly is social housing, and how does it differ, let's say, from in Singapore, HDB, or the Housing Development Board? So in Singapore, the HDB really provides subsidized housing for Singaporeans who can buy off HDB at discounted prices and be given various grants to help them pay for their deposits and get onto the property ladder. So it's really a great way to get onto ownership of your own property. And because you're buying it at a discounted rate from the government, when it comes to selling, you're almost certainly going to be making money. The difference with the UK government guaranteed social housing and supported living is that the UK provides free housing for special needs people that go through a strict vetting process that can be provided with free housing. So there is a significant difference between an HDB property that you're buying to get onto the property ladder and free housing for a special needs vulnerable person. So I hope that clarifies the difference, because I found in sharing this, often people make the assumption that it's the same as an HDB. So I work closely with a company called Yield Investing, and they're a developer that has specialized in social housing and supported living over the last 8 years. And they pride themselves on the ability to offer some of the most ethical investment opportunities available, whilst creating high investment yields and long-term inflation hedged rental income for investors. Now, it might sound a little strange when they say ethical investment opportunities. And really what they mean by that is, not only is this a compelling investment when we look at the figures, but actually from a social responsibility perspective, as an investor in this asset class, you are helping a vulnerable person have a roof over their head who might otherwise find themselves homeless. And so not only are you getting a great investment, but you're actually helping somebody and society with a great need. Now, yield investing will provide a complete turnkey package. So what yield investing do is they're constantly on the hunt for properties. They then find the right properties in the areas where they're working with what we call housing associations, which I'll come to in a moment. They completely renovate the property. So when it comes to purchasing that property, you've got a brand newly renovated property. They then work with what we call housing associations. These are regulated entities appointed by the government. And the housing association does several things. One, you could think of them as like the property management company that's looking after the property, but they're also the people that will be doing the vetting of those people to see whether they qualify for the free housing as well. So Yield Invest will deliver a full hands-free armchair investment solution for you, the investor. So again, what is social housing? Social housing is for low income or special needs individuals who can't afford market housing. It is owned and managed by local authorities or non-profit organizations known as housing associations. Now, for those of you who are not familiar with the terminology of a local authority, that's like a local government, or in Singapore jargon, it's a bit like a town council. So the housing association will also take care of the people approved to have the free housing, and they will then take care of the actual property on a day-to-day basis and manage that property on your behalf. Now, how the money flows is the government is your tenant. So central government then pays the local authority or the local government. Local authority then pays the housing provider or the housing association. And then the housing association would pay you, the landlord, directly each month for your rental income. And so again, this is really a very safe investment because the government is your tenant and they pay directly via the housing association. Now here we have some data on social housing, and if I draw your attention to the bottom left-hand graph in red and grey, we can actually see that social housing goes back 100 years. In fact, it was started really soon after the First World War. And what we see is in the red is the number of units being built for private residences, and in grey is the number of units being built in social housing. In the early 1940s, that plummets to zero. It's basically the time of the Second World War, where no construction was. Unfortunately, it was the opposite. You know, thousands of homes were flattened during the Second World War, and so soon after the Second World War, there was a major housing crisis and a major housing building program that was required, particularly in social housing, where we can actually see more social housing being built after the Second World War than in the private sector. But as we fast track through history, let's say we get into the early 1980s, the time of Margaret Thatcher. Margaret Thatcher was all about privatization, and she actually encouraged people to buy their social housing as opposed to effectively being given free housing through local government. But what happened was we can see a major decrease in the number of social housing being built. And as a result, what we've seen is more and more pent-up demand. One of the points towards the top right, it states that in 1990, the number of social housing units built was 28,000. In 2020, it was less than 7,000. In the 1960s, 3 million homes were built in social housing. In 2010, that less than half, or the 2010s, to 1.3 million homes. If we look down at the bottom right-hand corner, some of these bullet points show that there's 1.15 million households who are on social housing waiting lists at the moment. That's an awful lot of people. There is a direct need for, it's estimated, 150,000 social housing properties per year. And when we look at the last data back in 2020, only 7,000. So there's just a huge disparity between what's needed and really what's being delivered at the moment. And 51% of local authorities saw no new social housing rental homes delivered in 2019, 2020. So what's happening is that with this huge lack of social housing, the government is actually having to pay much higher costs to put people into temporary accommodation. So if we look at the top right, the UK was estimated to spend £1.6 billion on hotels and serviced apartments because of the lack of the social housing. I'm told that the cost of placing somebody in temporary accommodation is about 4 to 5 times the price of the rental it costs for a social housing. So there is a real motivation to get people to move into a social housing, but there's just a lack of it. Now, social housing, because of its low risk, high yielding, hands-off management, has meant that institutional investors have really been very interested in this asset class. One institutional investor called Triple Point has a portfolio of over 600 million. HomeRit has a portfolio of over 700 million. And when we look at major investors like Blackstone, Schroders, Morgan Stanley, Goldman Sachs, they've invested a combined over 10 billion into UK social housing. And this is an asset class that historically was only available to institutional investors until the likes of yield investing have come along and effectively packaged this for individual units for retail investors. So who are the vulnerable tenant types of people? Well, they can be homeless refugees and asylum seekers. They may be physically or mentally handicapped people who don't have an immediate family to provide assistance. It could be people from domestic abuse victims who need to get out of a certain situation and they need a roof over their head. Many of these, maybe I should clarify that the difference between social housing and supported living is that people that are purely going in at social housing, it's usually because they've fallen on economic hard times and they just cannot afford to rent in the private sector. And if they qualify, the government will provide social housing. The difference with social housing supported living is that these are the kind of people that need social support. So physical, mentally handicapped, or maybe somebody from a domestic abuse victim who needs somebody to provide social and psychological or physical support, who come into the property. It could be on a daily basis to provide that social support. And because of the additional cost there, the actual overall rental for the supported living is even higher than the traditional social housing. Now, what are some of the key benefits of investing into a social housing property compared with a traditional property? And they're numerous, as we can see on this slide. One of the main benefits is, number one, a full repairs and insurance lease. Basically, what that means is the housing association, which is really the property manager, pays for all of the repair and maintenance. So you don't have the repair and maintenance issues that would go with a traditional buy-to-let property, where you are going to be having to pay for those repair and maintenances. As the property gets older as well, it probably needs more repair and maintenance and starts to eat away into your yields. Number two, the rental income derived from the UK central government and local authorities. So the tenant is the government. So you have great peace of mind that you're not going to have a default. There is no service charge, no ground rent, no management fee, and as I mentioned, there's full damage cover. This is also a rental which is inflation linked each year. So the government will actually increase each year the rental based on inflation, albeit it will be capped at a maximum of 4%. So again, it's a very good investment that hedges against inflation over time. There's no maintenance fees. The rental is assured by the government. You have a full title deed ownership. Most of the individual units are freehold. Some of the blocks may be on a leasehold basis. You can sell the property at any time. And the government takes long-term leases. They can be up to 30 years. Many of the leases are then split into 5-year terms, which are automatically renewed every 5 years. So again, this slide really shows that when you're investing into this asset class, you've got a very stable income that's increasing every year. There are no void periods. There's no repair and maintenance costs. So the yields really are a true yield. And the housing association is placing the people into the property. You don't need to deal with tenants. You don't need to deal with renewals of tenants. It really is a hands-free armchair investment. Now, this is showing a cash flow illustration of a typical property. The entry level of these properties is around about £90,000, which, you know, for those of us who live in Singapore, you wouldn't even be able to buy the front door, let alone an actual unit. So this particular property that we've shown a cash flow illustration is priced at just over £116,000. It's providing a net yield of 9%, which gives you almost £10,500 of rent in your first year. But do bear in mind that each year the rent is adjusted upwards based on inflation. And so by year 10, if we come down, then the rental there would be at 13,600. Now, these figures are based on a compounding increase of 2% per year. Now, bear in mind that at the moment, inflation is running at just over 7% in the UK. So at the moment, you would have the maximum adjustment, which is 4%. So actually, the increase in rent right now would actually mean that your rent would be higher than the figures that are stated here as time goes by. So that's a growth percentage of over 30%. And over a 10-year period, your total accumulated rent is just over £120,000, which we can see is more than the purchase price. So over a 10-year period, the rental will have paid back for the property. And that doesn't include the growth in the capital growth of the property as well. So hopefully that gives you a quick snapshot of some of the figures. I hope that you can see the figures here. I appreciate they're quite small, but this is the availability price list of the properties at the moment. We can see at the top, if we look at the top one, that's an entry level at £90,000. The net annual rent is £7,200, and that net annual yield is at 8%. If we drop down to the third one, the purchase price there is £120,000. The first year's annual rent is at £10,800, and that's a net annual yield of 9%. There are a few blocks or small blocks of apartments. If we go down to the second from the bottom, there is a property that has 4 apartments in it. It's £800,000. That gives you a net annual rent of £72,000, which is equivalent to 9% net yield. And the very bottom one is just over £824,000. This is a combination of 6 apartments with actually 3 commercial units on the bottom, yielding a net yield of almost £66,000 a year, and that equates to an 8% net yield. So that's just a quick snapshot of what properties are available at this point in time. So here are some photographs. You'll see with a few of the properties that I'm sharing with you that the look and the feel, the materials used are pretty much identical. So the internal fittings out is all of a very similar standard. Interestingly enough, though, when you are renovating a property for the housing association for social housing, the building standards and specs and safety issues is at an even higher level than in the private rental market. So this is a 2-bedroom property, and it's Keswick Street, Hartlepool, where the purchase price is just over £116,000 with a 9% net yield, giving an annual rent of just under £10,500. If we build in the legal fees and stamp duty, the total outlay is just over £120,000. Now, you can see from the picture here, we're not looking at Buckingham Palace, but bear in mind that these properties are brand newly renovated, providing a roof over somebody's head, who's truly grateful for having the property. So I think it's very important to make sure that you're not trying to put your own personal thoughts that, I'll only buy somewhere where I live. I'm not necessarily looking myself to live in a property like this, but when I look at the numbers and the risk and the returns, it's something that does appear to be very attractive, as well as the social responsibility of being able to place a roof over somebody's head who might otherwise be homeless. So this is an example of a 3-bedroom property, and as you can see, the look and the feel and the quality of the fixtures and fittings is pretty much identical. This 3-bedroom unit is priced at £152,000, also at a 9% yield, and total costs when we build in the stamp duty and legal fees comes to just over £156,000. This is an example, it's actually been sold now, but this is an example of one of the larger blocks, which has over 31 one-bedroom flats in it, and is priced at just under 3.5 million, with a net yield of 7% and an annual rental income of just over 243,000. So you can see here there's quite a contrast from an entry-level property at £90,000 up to blocks that might go up to millions of pounds, and pretty much everything in between. So the purchase process is quite simple. Step one is to pick your property. Step two, there's a 5,000 reservation fee, which will take it off the market. Then you get into the legals, exchange contracts, and receive your title deed and earn your rental income. There's no void period. The day that you complete on your property is the day that you start accruing the rental. And as I mentioned, most of these properties are freehold. And typically, this process takes about 1 month. So let's move to the third and the final investment asset class. I'm just going to grab a drink because I'm getting a little bit croaky. So UK short-term property bonds. So I've worked with this particular developer for many years now. I used to work in developer financing, so I'm very familiar with different structures of how developers seek funding. Most people who may be outside of the industry just assume that developers will only go to the bank and that's the only way to raise funding. Absolutely not. They may go to private equity markets, they could be going to family offices, institutional investors. But in this case, the property bond is seeking investors like yourself who lend money to the developer, and in return, the developer provides you an attractive interest rate over a 1-year term. So that's in essence what a property bond is. The company that I've been working with is called the 79th Luxury Living Group. This is David Webster, the founder. He's been in the industry for over 30 years. At one point in time, he was the largest private landlord in terms of the number of properties that he owned. And he's now developed a significant personal and corporate portfolio with developments in excess of over 500 million in both commercial and residential property. Now, their business model is a little different from a traditional developer. A traditional developer goes out and tenders for land and buys the land at market price, will then often tender for the contractor at market price, and hopefully gets market normal profit margins that could be between, let's say, 15 to 25% profit margin. This developer will only focus on distressed and undervalued property. And by doing so, their profit margins are typically between 30 to 50%, which is great for the developer. And at the end of the day, de-risks you, the investor, because the major thing for these kind of property bonds is can the developer deliver? If they can deliver and build the property, there really is very little risk. And I will only work with a developer that's got typically a minimum of a 20-year track record, because they've demonstrated that they know how to run a development business. They've gone through different economic cycles. And although it's no guarantee of future success, it does mean that they run a good business and have gone through various challenges through different economic cycles. So this developer's business model is they will identify a development, and again, they focus only on distressed and undervalued properties. Once they've identified it, they are raising funding a variety of ways, of which one of them is through the property bonds. Those property bonds then give them an opportunity then to use those funds to acquire the sites. Once the site is acquired, they will then obviously build and construct. And then the exit strategy is not purely based on one exit strategy only. Most developers would be looking to sell the units. This developer does look at that, but let's say the property market turns and the property market takes a hit and the property prices drop. this developer has other alternatives, such as refinancing the property, keeping it themselves, and keeping it in their own portfolio for a rental yield. So this gives them the flexibility that they're not based on one exit strategy, and if the market turns against them, it could cause some issues. So this is the basic structure of a property bond. It's a fixed income loan note. This is often used in the UK for a property bond. So this is fixed income. You get exactly what it says on the tin. The minimum investment, depending on which property bond you go into, one of them is at £10,000 minimum entry level, the other is at £25,000. Interest can be paid in several different ways. If you go for the 12% annualized return, it's actually paid at 1% per month. If you go for the 15% option, it's paid at 7.5% every 6 months. And since this slide was made, they've actually introduced an option at 17%, where the interest is paid at the end of the 1-year term. And they're all, in this case, 12 months. They do have a few options which are 2-year terms, but the majority is a 1-year term. Now, here's a table that I created. If we look at the bottom table, which is taking 15% interest rate, which the present and most recently launched property bond offers between 12 to 17%, so 15% is roughly in the middle of that. If you were looking at a 15% interest rate over a 1-year period of time, let's just take the example of a £10,000 investment, the minimum entry level for one of the property bonds. And assuming that at the end of the 1 year, you decided to redeploy both the capital and the interest you earned, and you were to keep replicating that over 5 years, when we look at the far right-hand column, the 5th year, you will have turned £10,000 into just over £20,000, or effectively just over doubled your money in 5 years. So when looking at a 15% interest rate and compounding that each year, it really becomes very powerful, where you can, as I say, double your money in 5 years. Now, this is a secured loan. And what do we mean by a secured loan? Well, for most of us who've taken a mortgage with a bank, we'll know that the bank who's lending us the money will take a first charge on the property, so that if we were to stop paying our mortgage monthly repayments, at some point the bank is going to step in and repossess the property. Well, in this case, the security trustee, which is a regulated company at arm's length from the developer, actually holds the title deeds of the property on behalf of the investors. And so if, in the very unlikely scenario, the developer were to default and not pay you your interest or your capital, then a default would be triggered. The security trustee would step in, repossess the development, and sell it off to recover your capital. So it is very similar to the structure of how a bank protects their position from a mortgage, but it's just on a larger scale. Now, the security trustee do lots of other things as well. They monitor the loan to value to make sure that the value of the development always outweighs the liability of the loan. One of the mandates of the security trustee is that the developer must always maintain at least 6 months of working capital to honor the next 6 months of its financial obligations, which includes servicing interest and paying out any investors who want to redeem their capital. They monitor the insurance policies, making sure those are in place. They make sure that no charges are put ahead of the investors. So they do a great job in terms of protecting the interest. And as I say, they're a regulated company that is at arm's length from the developer. And this is a nice flow diagram, which really brings the investment structure together. If we start at the top right-hand side, where the loan note holders or the property bond investors, that money goes into an SPV, a special purpose vehicle, which is then used to acquire the assets or the development sites. Very often they're buying assets which is not just the land, but it's a distressed asset. It might be a shopping mall, it might be an office, it could be a cinema. Actually, one of the ones that they did last year was a hospital that was upgraded, and the town had a brand new hospital, and this became obsolete. So going back to the low note holder rectangle, as we come downwards from that rectangle, it directs us to the security trustee, which, as I mentioned, holds a debenture, which is an equivalent of a first charge over the assets of the developer and the development. And so in the unlikely scenario that there is a default, the security trustee can step in, repossess the developer's assets, and sell those off to recover your capital. So the track record of this developer has a very solid track record in terms of issuing bonds to investors. It's been trusted by over 600 private investors and institutional investors in over 25 jurisdictions. Over 10 million, in fact, that's gone up quite significantly since this slide was made, have been repaid capital to private and institutional investors. The directors, many of them are award-winning with OBEs and CBEs, and they have a 100% track record of capital and interest repayments. And here, this is a snapshot. They've done over 32 developments. 5 projects are currently under management with a total combined value of 26 million. Most of the developments that they do are quite small and boutique, which means they're much easier to sell 10, 20, 30 units compared with a developer that might be developing thousands of units. And if the market turns, there may be some challenges. So here's an example. In fact, this one, I know some of the people on the call tonight have been into this particular property bond. It's actually a town called Hexham, which I know is quite close to the university I used to study at. What we see in the left-hand corner is what it looks like after it's been renovated. It used to be a hospital. It was a 150-year-old building in the center of the town, but the town relocated to a new modern hospital. And they actually bought this at a 50% below market value, and then turned it into modern apartments, 34 in total, with a combined gross domestic value of just over £10 million. Here is actually just 3 luxury properties in the town called Formby. For those of you not familiar, it's a very wealthy town just outside of Liverpool. The developer had very close ties to Liverpool Football Club, and actually rents these out to professional footballers. So they know when they built these, they've already got tenants to come in who are obviously extremely highly paid and can pay for these luxury properties in Liverpool. And this is an example of 65 units with a total GDV of 8.8 million. This is the latest property bond, and basically there are 4 different options, or 4 different series as they're called. The first one pays at 12%, where the interest is paid on a monthly basis with an entry level of £25,000. There is an option to get 15%, which is paid biannually at 7.5% every 6 months. Series C, if you wish to invest up to £100,000, is 15% per annum, paid on a yearly basis, but that's paid on a monthly basis. So I think that works out at about 1.25% interest per month. Or the Series D is at 17%, which is paid at the end of the 1-year term. So those are the 4 different options in the latest property bond on offer. As I mentioned, there is another one that starts at just £10,000 and offers a 12% rate of return paid on a month, 1% per month. Now, another great thing that the developer offers is many different currencies that you can invest in. So for those of you who are on the call from Singapore, you can see that there are Singapore dollars, but there are other major currencies such as the Australian dollar, the US dollar, euros, pound sterling. So you can decide on whether you want to invest in your base currency, let's say that's Singapore dollars, which takes everything of currency risk out of the equation. You invest in Sing dollars, your monthly or your interest coupon returns are in Sing dollars, and your capital repayment would be in Sing dollars. Now, that said, some people would say, well, actually, the Sing dollar is very strong. The pound sterling, when we look over the last 10 years, is on the weak side. Maybe I will take a little bit of a punt and I'll convert my Sing dollars and invest in pound sterling. I'll obviously get my fixed rate of return, but I might even make on the currency exchange rate at whatever time I'd like to repatriate that back into Singapore dollars as well. So the beauty of this is you have the choice. You can choose which currency that you'd like to invest in and potentially take out any currency risk as well. Now, if you do invest, this is an example of what you'd get. It's actually one of the investments that I have done. You'll get a certificate of investment showing how much you've invested and when you started the investment. There'll be a breakdown of schedule of payments. So this one basically pays 1% every month, and so shows that schedule and shows you when the end of the term is and the capital repayment back to you. There's also something called a deed of accession. And in layman's terms, what it's doing is it is registering your contact details so that the security trustee knows who you are, where you are, how to contact you, so that if in the unlikely scenario there is a default, they have got all of your details and again can pay you back once they've sold off the property. So that brings me to the end of the 3 different investment strategies. What I'm going to do now is show you this table and start to look at the pros and cons and comparing the different kind of investments. Just excuse me one moment. Now, I want to reiterate, there is no right or wrong investment here. As we go through different seasons of life, it might well be that your risk appetite and the kind of investments change. And as a very crude and generic assumption, it may be that during somebody's earlier working years, somebody in their 30s, 40s, maybe early 50s that still got, at least 10 years of working life left, it may well be that their job pays them enough salary to maintain the quality of life they like. And it may be that their focus is on building capital growth and accumulating wealth that way. But as somebody gets closer to retirement, it may well be that income generating assets become more important. And it may be that they start liquidating some of their investments to be generating income to supplement their retirement years. And certainly as we get closer to retirement, generally people are looking for low risk, safer styles of investments. So just comparing here, I mean, there are lots of things that could be compared. Down the left-hand column, we can see some of the things that I have compared. And when we look at any investment portfolio, it should really have a balance of long-term, medium-term, and some short-term investments. And here, within these 3 different investments, we can cover all 3. In the traditional property investment, we would normally inform investors to look at a traditional property investment and be holding for a 5-10 year period or more. For the UK social housing, I didn't mention earlier that the developer will actually do a 3-year automatic buyback at a 10% premium. And so in my personal definition, you could exit in 3 years, which I've stated is really like a medium-term investment. But if you wanted to, you could hold it indefinitely, just like a traditional property as well. And the property bond is just a 1-year time frame. And so I've defined that as a short-term investment. The investment quantum, for the traditional property investment, if you're looking to get a mortgage as a foreign investor buying into the UK property market, you really need to be looking at a purchase price of at least 135,000, as most banks won't entertain a mortgage for anything less than that. Obviously, you could buy in cash as well. UK social housing entry level, as we've seen, is £90,000, and for the UK property bond at just £10,000. Taxes. So some of the main taxes is SDLT, the stamp duty land tax, income tax, and capital gains tax as well. So these are the three taxes that you need to be aware of when buying a property. Roughly speaking, well, the stamp duty land tax goes up in tiers based on the purchase price. Anything below £250,000, there's no basic stamp duty, but then it goes upwards to over £1 million and starts to increase quite significantly. Income tax in the UK starts at 20%. After the first roughly £38,000, you're up to 40% for anything above that. And if I remember rightly, above £125,000, you get into 45% income tax bracket. And the capital gains tax is between 18 to 28%. So the same taxes apply to the UK social housing. Now, that said, because all of the individual units that the developer provides are less than £250,000, so actually the stamp duty is very nominal. There are other forms of stamp duty for non-residents and for people who are buying an investment property. Income tax remains the same, and so does capital gains tax. When it comes to the property bonds, then if you're a Singapore resident, and I believe it's the same in Malaysia, you don't get taxed on this in the UK, and in Singapore and Malaysia, you don't get taxed on interest. So in effect, is tax, well, there's no tax. Acquisition costs for your traditional property, it can be high. It really does depend primarily on the purchase price of the property. As mentioned, anything above 250,000, you're going to start getting hit with the normal basic stamp duty, and anything that starts to go over £1 million, that goes up to, I think, a maximum of about 15% stamp duty. But it's nowhere near as bad as Singapore. For a foreign investor investing into a Singapore property, you're now paying 60% stamp duty. UK social housing, I should say there are other acquisition costs. The other one is really the legal fees that you would pay. For the UK social housing, the acquisition cost, I would say, is medium to low. As I say, there's very little in the way of stamp duty because most of the individual units are all under £250,000. So you're really looking at some legal fees and some of the ancillary stamp duties. And for the property bonds, again, there are no acquisition costs. So all of your money is going into your investment. Management fees. If it's an overseas property, you're almost certainly going to want to appoint somebody to manage your property. A property management fee for a property outside of London typically is about 10% of the rental income. In London, it's a little bit higher, typically between 12 to 14% of your monthly rent. For UK social housing, the yields are net yields, so there are no management fees. And likewise, there's no entry fee and no management fee for the property bond, so 100% of your cash is working for you. Time to complete the investment. If you are looking at a traditional property investment and you are getting a mortgage, the mortgage application typically is the most arduous and lengthy part of the whole process, and means typically your purchase from the time you reserve a unit to exchanging contracts and potentially getting the mortgage application approved could be 2 to 3 months. With the UK social housing, they are cash purchases, so you don't have the arduous part of applying for a mortgage. And so typically you are exchanging the contracts within about 1 month. And with the UK property bond, it can be done easily within a week. In fact, I can do it within a few days once I've got the application form and supporting documents. Typically within 2 to 3 working days, the investment is live. Leverage, a leveraged investment. So what I mean by that is a traditional property, you can get a bank loan and you can leverage your money, which significantly increases your return on investment. The reason I put yes, no is because obviously there is an option to take a mortgage, but some people might choose to buy in cash. So in that case, it wouldn't be leveraged. As I mentioned, the UK social housing is a cash purchase, so it's not leveraged. And likewise, for the property bond, that is not leveraged either. Time efficiency, in terms of how much time and energy do you need to put into your investment. Time is a resource, and as you start acquiring more and more properties, it can start to build up in terms of how many babies you need to manage. It can be labor intensive, as I say. The acquisition can be 2 to 3 months, and it can be sometimes quite a painful process to apply for the mortgage. Once you've acquired the property and appointed a property management, the management company should be taking care of most of it, but you are going to have repair and maintenance issues. You're going to have renewals of tenants, and dare I say, if you are unfortunate to get a bad tenant who doesn't pay you the rent, it can take up to 6 months to evict somebody. So having tenants insurance is often a wise decision, so that if in the unlikely circumstance you do have a rogue tenant that doesn't pay your rent and you have to oust them out, at least the insurance will cover your rental income, as well as covering any legal fees to evict them. With the UK social housing, as I say, it takes 1 month. So once you've done the conveyancing side of things, there really is very little, if anything, to do there afterwards. And for a property bond, there is no additional work that is required once you've done the application. The risk level. Now, this is something I had to ponder and wrestle with. And so you may have a different sort of definition of what the risk is, but hear me out and you can apply your own definition of how risky you think these investments are. But when it comes to a traditional property investment, there are 3 risks that I'd really like to highlight. One is what we call development risk. If you're buying off plan, there is the outside chance that the developer does not build the property, in which case you may well lose 100% of your deposit. Mortgage risk. In the UK, if you're buying an off-plan property, let's say it's 2 years until completion, you may be able to get an approval in principle from a mortgage broker, but you won't actually get a formal mortgage offer until 3 to 6 months before completion, which basically means things might change by the time you are signing a sales and purchase agreement today, but your completion is 2 years down the road. Something might happen. You might lose your job. You may go through a divorce. This could change your financial profile and your eligibility for a mortgage. So there is what I refer to as mortgage risk. And the other one is currency risk. If I take Japan as an example, if you bought a property in Japan recently, the property prices haven't appreciated hugely, but the currency has depreciated almost 30% in recent years. And so if you were selling it at the moment and then repatriating the yen back into Singapore dollars, you could end up actually losing money in total. So currency risk needs to be factored in as well. So when it comes to buying a traditional property, if you want to mitigate some of the development risk and mortgage risk, then you can focus on just buying a property that is within 3 to 6 months of completion, or a property that is completed, because then you have no mortgage risk. And when it comes to, you have no development risk. And typically, if it's completed, you can have a clause in your contract to say that I'm only signing my sales and purchase agreement and legally binding myself to this purchase once I've got a formal mortgage offer in place. Now, there is still currency risk to evaluate as well. When it comes to the UK social housing, because there is no mortgage risk, you are buying these in cash. They are renovated, completed property, so there's no development risk. And at the end of the day, the government is your tenant paying you a yield with no void periods and all the benefits I've mentioned. So I've defined this as very much a low risk but high yielding investment. And when it comes to the UK property bond, I put this at medium, but as I was thinking this through, I would almost say that you could argue that if you're working with a developer that has a long track record of consistently delivering, on top of that, it is a secured loan by way of a first charge. So if the developer defaults, you can recover your funds. You could argue to say that that is less risky than buying an off-plan property in a traditional development, whereby you might be putting down a 20–30% deposit. And if the developer doesn't deliver, you've lost your entire deposit. Now, that said, there are some developers that provide insurance warranties for the first 10%. So at least you do have some coverage on your deposits. But one could argue to say that buying off plan, the traditional development, potentially has more risk depending on the quality of that developer and its ability to deliver compared with a property bond. And so the last point comes back to the question I asked earlier, is what sort of annualized returns would you be looking for in a UK real estate investment to make it of interest to you? Now, at the bottom here, the traditional property investment, typically plus or minus a few percent, is looking at around 15% per annum. But that's when it's leveraged at about a 70% loan to value. If you were buying the property in cash, I would, instead of a 70% loan to value, buying 100% in cash, then that return would drop down to about 5 to 6%. So we can see the power of leveraging and using bank financing to increase your annualized returns. When it comes to the UK social housing, I've derived the figure of 12.3%. I've used an assumption that the client is going to trigger a 3-year guaranteed buyback with a 10% premium. You're buying the property at a net 9% yield, which does adjust over the 3 years. But let's just say, for the sake of argument, say you've got a 9% yield times 3 years, that's 27%. Plus you sell the property at the end of the 3 years for a 10% appreciation. That's a 37% return over 3 years. Divide that by 3 and it's roughly 12.3%. And when we look at the property bonds, these are providing fixed income at 12 to 17% rate of return. So I suppose my question to you is going back to saying, okay, well, if you like real estate as an asset class, you're comfortable with the UK property market, it now comes to asset allocation. How much should I allocate to each of these investments? Should I put it all in one property asset class, or should I split it over 2 or 3 of these different investment asset classes? And this really then comes down to having a conversation with myself, you know, what season of life you're in, what your risk appetite is, your time horizon, and really all the things that I've tried to compare and contrast in this table so that you can make a well-educated and informed decision of what may be the right investment or investment asset classes for you. So this really brings me to the final slide, and basically having spoken with the developer and of the social housing, Yield Invest, and the property bond provider, they're offering an opportunity whereby if you were to invest in a social housing unit before the 31st of August or by the 31st of August, it will provide £1,000 discount of any unit you wish to purchase. Or if you wish to go into one of the property bonds, there will be an additional 1% bonus paid for any one of the UK property bonds if you were to invest before the 31st of October. So that pretty much brings me to the end of the presentation. Before we go into the Q&A, I just would like to share with you a book that I have co-authored recently, which is called Gold Nuggets for Entrepreneurs, Lessons That Change Your Life. I was approached by the main author and asked to write a chapter. And at first I wondered, what is it that I could contribute? What might be something of value that readers might wish to read and actually learn something? And I thought to myself, well, I've worked in sales and marketing in various capacities in finance, real estate financing, international property investment marketing. And I've seen over the years a whole variety of very good sales and marketing people and very bad sales and marketing. And so I thought, having run my own businesses, I would share some of my thoughts about the longevity and how to last in a sales career. Basically, I suppose that at the heart of what I wish to do is provide good, ethical, honest sales feedback and advice so that my clients will build up a high level of trust, a high level of credibility, so that I can grow my client base, and in turn, they will do more investments, and in turn, they will refer their friends and family as well to grow my client base. So this is available on Amazon. My colleague should be putting into the chat box that you can see at the bottom right-hand side a link to the Amazon link where it can be purchased. It's not that expensive. I think the hardback is about $13, $14 US, and the paperback I think is as little as $6, $7 US. I've just contributed one chapter, but there are many people from various walks of life that have shared their gold nuggets, and definitely is well worth the read if you'd like to purchase one of the books. So what I'd like to do now is open up the floor to question time. I'll do my very best to see whether I can answer those questions. I haven't yet had a chance to look at the chat box, so I'm going to open up the chat box. You can see some of the links that my colleague has put into there. The first link is actually, if you couldn't read the price list and availability list slide, there is a link to the Google spreadsheet, so you can have a look at that and download that. The second one is the link to the Amazon, if you'd like to know more about the Gold Nuggets for Entrepreneurs book that I've contributed to as well. So please do feel free to put your questions in the chat box below, and I'll do my very best to answer them.
Richard, I think, boss, you have missed to see Frank's first question.
Oh,
at the top part of the
so
chat
there is.
messages.
Yes, I didn't scroll up there. Thank you for that.
Mm-hmm.
So Frank, the question is, the leader of Birmingham City Council has said it has faced with stark choices as councillors approved a financial recovery plan. The authority declared itself essentially bankrupt early this month, in part over a 760 million equal pay bill. Any implications to your proposed social housing scheme? Interesting you said that. Of course, it was pretty big news. There are several other local authorities that have also gone bankrupt over the years. So it's not like an isolated case, which again isn't necessarily positive news. But this particular case was about the equal pay rights, and that there was a backlog of equal pay that hadn't been paid for some time, and through legislation, through equal pay, to be able to pay that actually put the local authority into bankruptcy. Now, that said, the local authority said that all essential services would continue as normal. This was on the BBC News, and it even highlighted social housing because, again, you don't want the position where people are literally being put out on the streets and made homeless. So, excuse me, one of the top priorities was actually still providing the social housing. And I think that that would still be the case with most local authorities that go across the UK. So, next question. How is the UK property bond not subject to HMRC tax? how is it structured? I have to caveat myself, I'm not a tax advisor, but I have many clients based here in Singapore and Malaysia that have invested in this. I have spoken with tax advisors, and it's basically an interest. And as a non-resident of the UK, as an interest, you don't get taxed on interest as a non-resident. And as a Singaporean, then you also don't get taxed on interest payments, a little bit like you don't get taxed here in Singapore on dividend payments. So, you know, from a tax perspective, you know, it's great. These are, for those people living in Singapore, non-taxable. So again, not only are there no management fees, there's no entry fees, there is no taxes. So you realize 100% of your returns. A common question that I get when it comes to the property bonds is that, well, why doesn't the developer just go to the bank? Surely they can save an awful lot, and the interest that they're paying to a bank would be a lot less than what they're paying in 12 to 17% to the private investors. And the answer is yes, that's true. The interest rate would be lower. It's not like you know, the interest rate of a bank, but construction finance is probably running at about 8 to 10% in the UK at the moment. Here's the challenge, though, for the developer. The developer, you may remember, specializes in distressed assets. And the seller is very often about to get that property repossessed. And it may be weeks or maybe a month before that property gets repossessed. Now, we know that going to apply for just an individual mortgage can take, you know, anywhere from 2 to 3 months, with no guarantee of getting the mortgage at the end of that. For construction finance, it can take easily anywhere from 3 to 6 months, again, with no guarantee that the bank is going to finance it. By which time, either the seller of the distressed property has had the property repossessed, or somebody else who's got the cash, who can quickly come in and buy it at a big haircut, will have come in and done so as well. So by raising money through these property bonds, it gives the developer a war chest of cash that they can then utilize and have that cash available to go in and buy quickly once they've established that this is an extremely attractive investment where they're buying well below market prices. So that's a very common question that I get for the property bonds. Okay, Frank, thank you very much for the excellent information and presentation and answer to my question. Thank you, Frank, for joining us. Are there any other people with any other questions? I don't know if I've bamboozled people or I've already answered most of your questions as we've gone through. I remember when I previously did a webinar on the social housing, people were asking, well, you know, what really is the risk? Where is the risk in this? Because I've had some very savvy investors really try to pull this apart, and they've really struggled to see where the risk is. I think the only risk that you never know might happen is if a new government comes in and changes the social housing policy, could that change the situation? Now, having said that, there are literally millions of people that depend on free housing in the UK. It's not like Singapore. So if there was a major change in policy, and let's just take an extreme example where the government was to say, we are no longer going to provide free housing, the result would be that millions of people overnight would be on the streets. There would be a major social uproar, and quite frankly, it would be political suicide. So, you know, I very much doubt that, you know, the UK government would change that. So, Mr. Leong, HMR says non-residents have to pay tax on interest. Okay, well, I will double check this. I have spoken with tax advisors, And I have also spoken with the property bond issuer, and to my knowledge, and I've asked multiple people, then non-residents living in somewhere like Singapore do not have to pay tax. But let me double check on that. So thank you for highlighting. Any other questions? I appreciate we've run over time today. I did say it would be between 8 to 9. I appreciate that there's been a lot of content to cover, so I appreciate for those of you who've stayed on the call tonight. If there are no other questions, then please do not hesitate to give me a call, WhatsApp or email. And again, do remember that the opportunity, if you wish to invest before the 31st on a social housing unit, you can save £1,000 or get an additional 1% interest bonus on the property bond. So as you can probably hear, my voice is starting to crack a little bit as I've been doing a lot of the talking. I thank you again for coming today, and have a good evening, and I'll be delighted to stay in touch and answer any questions that you may have over the next day or two. Thank you and good night.